Hello, I'm Tony Venosa, Senior Options Strategist with Schaeffer's Investment Research. I've been trading the markets in one capacity or another for about 15 years now. Today's lesson is short-term aggressive options trading, which I absolutely love. So, what is short-term aggressive options trading? Basically, it is directional premium buying through the use of a call purchase or a put purchase on an equity or sometimes an ETF or an exchange-traded fund. The aggressiveness is based on my option selection, which is usually front month or second month expirations, meaning I'm playing a 1 to 6, 8 week time frame. I'm using at the money or slightly in the money options. This means I choose my strike price in the close vicinity of the equity's current share price. For example, a stock may be trading at $51 a share, and I may purchase a $50 call option, which may be expiring in 1 to 6 weeks. The objective is to get an immediate explosive move in the underlying equity. Because at-the-money options have big time decay built into them, I have to be very precise in my entry. A stock that does not move or goes in the opposite direction will turn an option position into a quick loss. So, you may ask, why do I love this type of aggressive trading? Well, for one, the payoff can be huge. The ability to make huge outsized returns in a short amount of time by taking advantage of the concept of convexity. Convexity refers to the option's ability to exponentially increase in value versus the linear increase in the underlying. Now let's take a look at this chart, which represents a graphical example of convexity. The gray bars down here represent the equity's individual returns had you owned just the shares. The blue line, going from the lower left to the upper right part of the screen, represents the corresponding returns on the option. For example, I could have a gain of 12% on my shares, but if I had purchased an at-the-money call option, I could be up roughly 233%. Now, here's how convexity works. Let's say the share price continues to move higher, and I am now up 15% on my shares for a gain of 3% from before. The gain on my option is now 317% higher. So, understanding convexity makes short-term options trading very attractive. Another reason why I love aggressive short-term options trading is the returns are not always correlated to general market movements. This means the general market could possibly be flat, but my returns on options tradings can be drastically higher, or hopefully not, but lower. Which brings me to my next point. Opportunities abound in all market environments. Patience is key here. Opportunities will always present themselves no matter what the general market is doing. I can always find puts to play in raging bull markets, as well as finding call plays in vicious bear markets. This gives me great flexibility in my ability to generate returns far greater than the general market may offer. The moment I place a trade, I know exactly what my worst case loss will be, which is equal to the premium I paid to own the option. So, if I purchase $1,000 in call options, I know if a catastrophe happens to my stock, the most I can lose is the $1,000 I laid out. This is a comforting feeling knowing my risk can be defined at a worst case 100% loss. But the upside is the ability to make returns in excess of 100, 200, and even 300%. Here at Schaeffer's Investment Research, this is how we do it. We have a service titled Players, which trades exactly in this manner I've been discussing. You can find more information on our website at www.schaeffersresearch.com. Okay, let's move on to the factors I consider when looking at the universe of all optionable stocks. The first thing I look at is liquidity characteristics. That is the stock actively traded each day? I try to restrict myself to stocks that trade at least 1 million shares per day, but the more the better. The more liquid a name, the purer the price action. No one can play games with the share price in the near term. The same can be said when looking at the open interest in a stock's option. Open interest is defined as the total number of contracts, puts plus calls, that currently remain open. Again, the larger the open interest, the better the liquidity. This may mean tighter bid-ask spreads, as there tends to be a lot of two-way trading, meaning there are plenty of buyers and sellers, not just market makers taking on the other side of the trade. Next are volatility factors. Has the stock shown its ability to make outsized moves in the past? This can be done by simply looking at a stock chart. Look back over the course of, say, a year and try to identify nice swings in the stock. Stay away from choppy stocks. It's the worst nightmare for a premium buying options participant, unless you have a clear edge as to knowing a choppy stock may enter a trending phase. Okay, let's jump right in, and I'll show you an actual trade that I placed back in 2011. This is a monthly chart of Green Mountain Coffee Roasters, ticker GMCR. I like to always start with a big picture view on the stock, and that starts with the monthly chart. As you can see, the shares of GMCR are in a trending phase with a clear uptrend in place. Recently, shares broke out of a consolidation phase where shares were generally range-bound between $20 and $32 for the better part of the year 2010. As you can see right in here, break out of this kind of rectangular formation. Now, dialing down to the daily time frame is where I time my entry. Here's a look at the daily chart of GMCR. At the beginning of February, right in here, we had a huge gap up and a continued run higher through the $40 level to close at all-time highs. During the latter part of February and the first half of March, shares retraced a part of this upthrust right down into here. As you can see by the yellow shaded area, the daily ranges contracted to a low in volatility as depicted by the Bollinger Band Width Indicator down in the lower pane, right in here. With shares consolidating just above the round number $40 level, right in here, I immediately placed this stock on my stalking list where I am constantly watching the price action to determine my entry point. On March 9th, I recommended the purchase of the March 41 strike call at a maximum entry price of $2.60 a contract, or $260. As you can see on the chart, shares started to move above the $42 level, which was my trigger point. The very next day, shares jumped over 30% on the open. I recommended closing the position during the first half hour, collecting over 560% in one day. Now, I understand this is an extreme example where luck definitely played a factor, but my point is to show you the exponential returns one can make by playing options. So, how do I find these types of explosive directional moves? First, I scan for stocks that experience a contraction in volatility, that is, resting after a recent strong or trending move. To quantify this, I use the Bollinger Band Width Indicator, which is found on most charting programs. I set my Bollinger Bands to a 6-day, 2 standard deviation setting, which is a lot different from the standard default setting of 20-day, 2 standard deviations. I like to use settings on most of my indicators a lot differently than most people do, so it keeps me out of crowded traded situations. The next factor I consider is the pricing of the options. I want to buy cheap, underpriced options. A couple of ways to determine this is to compare the current implied volatility to post-implied volatilities. Also, comparing current implied volatility to a number of different historical volatilities can ensure I'm playing an undervalued option. Other technical factors I use to support my case for the anticipated direction include, but not limited to, our non-standard moving averages on monthly, weekly, and daily charts. That is the 40-day, the 80-day, the 160-day, the 195-day, and the 320-day moving averages. I use gap areas, price support resistance levels, trend lines and technical patterns, Fibonacci retracement levels, year-to-date levels, plus or minus 10% levels, 50% and 100% levels, round number price levels, half highs and double O's. All can make for interesting entry and exit points. Let's look at another example. This is a monthly chart of a Chinese tech stock called Yoko Tudu, ticker YOKU. As you can see, shares were in a long-term downtrend from mid-2011 all the way to the end of 2011. At the end of 2011, shares failed to make another lower low, right in here. Eventually, shares were able to successfully overtake the round $20 level after breaking the downtrend line right in the beginning of 2012. Here's the daily chart of Yoku. February saw a partial retracement of the current price strength the stock had experienced thus far in 2012, which was up at this point 33% year to date. Shares pulled back to this 80-day moving average, this purple line right in here, where back in 2011 it served as resistance, where right now it could possibly be serving as support. You can also see in the lower pane the Bollinger Bandwidth contracted in volatility, alerting me to a possible expansion coming in the very near future. I do not plot the actual Bollinger Bands on the chart because I think it crowds the chart too much. But if one were to plot the Bollinger Bands, you would see a pinching together of the upper and lower Bollinger Bands. On February 17th, 2012, I recommended the purchase of the March 21 strike call at a maximum entry price of $2.50 per contract. Following a couple of weeks, Yoku moved higher, allowing us to exit with a total profit of 170%. Along the way, I recommended taking partial profits at these red arrows. Now let's look at an example where a stock dropped. This is a monthly chart of Freeport-McMoRan Copper, ticker FCX. The long-term view took on the shape of a multi-year triangle formation with shares currently hitting resistance at the $40 level right in here and the downtrend line. Dialing down to the daily chart, you can see shares were stalling just beneath the 40-day moving average and the $40 round number level, which shows a brief time above this level back in September and October, taking on a double top formation. As you can see, a contraction in volatility as quantified by the low Bollinger Band width reading. Dialing down to the daily chart, you can see shares were stalling at the $40 level and this red line, which is the 40-day moving average, which shows a brief time above this level back in September and October, right in here, forming a double top formation. As you can see down here in the lower pane, the Bollinger Bandwidth reading was quite low, indicating a contraction in volatility. On November 30th, I recommended the purchase of the December 39 strike put at a maximum entry price of $1.20 per contract, or $120. A few days later, FCX announced they were acquiring two oil companies, McMoRan Exploration and Plains Exploration. Shares reacted negatively with a 16% drop in value. I recommended selling the puts that day, profiting more than 450%. Again, these types of trades do not occur every day, and luck certainly played a factor, but it is worth noting these trades do show up and they can make a person's year. Let's look at our final example. This is a monthly chart of Ford Motor Company, ticker F. As you can see, Ford has been trading between $9 and $13 a share for over a year. Currently, shares are trading at the top of the range, right in here, with the 195-month moving average serving as long-term resistance, as depicted by this yellow line in here. Now, dropping down to the daily time frame, you can see Ford consolidated in a tight range just above the 0% year-to-date level. Bollinger Bandwidth had dropped to the lowest level all year, right in here, telling me that an imminent move was coming. On February 19th of this year, I recommended the purchase of the March 13 strike put at a maximum entry price of $37 per contract, or 37 cents. As you can see, Ford shares quickly dropped through the 0% year-to-date level. On February 26th, I recommended exiting a quarter of the position at the 80-day moving average for about 80 cents for more than 125% profit. My next target was near the $11.50 level, which was the top back here in November and December of 2012. Unfortunately, shares reversed, resulting in a total loss on the final three quarters. My point in showing you this failed trade is twofold. One, your trades will not always be successful most of the time. Secondly, in order to make the really big money, you have to give the trade plenty of room, even if that means losing out on the final 3 quarters. Short-term aggressive options trading is not for everybody. The swings can be quite large on a day-by-day and week-by-week basis. It is not for the faint of heart. You must have perseverance and the patience to withstand the high volatility you'll likely experience not only in your personal account, but with your emotions. With that being said, there are huge possibilities to make the really big money we are all looking to make. Because my win rate tends to be lower than most strategies due to the aggressive nature of the trades, it is the utmost importance that my winners be large enough to outweigh the inevitable losses that will most certainly occur. I hope you enjoyed today's lesson on short-term aggressive options trading, and hopefully we're able to take something away from this presentation. Good luck and hope to see you next time.